Happy Friday out there, Team 42. It's your skipper here, Darius to present our macro minute for Friday, July 19th, 2024. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what specific changes you need to make in your portfolio, if any, to stay on the right side of market risk, you need to be a client of 42 Macro. So today's key macro questions is what impact will the latest improvements to the 42 Macro risk management process have on client portfolios? Our answers, we spent much of the past 36 hours coding improvements into two of our core models, our volatility adjusted momentum signal and our 42 macro global liquidity proxy. Regarding our VAMS model, we added a recovery overlay to make the signal more reactive to liquidity fueled V bottoms in asset markets. The net result is clients implementing our trend following signals will enjoy a much improved upside capture ratio at the start of bull markets while maintaining all the same benefits of maximizing upside capture throughout bull markets and minimizing downside capture at the start of and throughout bear markets. Regarding our 42 macro global liquidity proxy, we added a bond market overlay to better account for the impact of rising and falling haircuts to collateral in the repo market in influencing cross-border financing. Our model is now directionally consistent with other notable global liquidity measures across global Wall Street. The net result is global liquidity is in a modest uptrend, but for all intents and purposes, it has been stuck in a holding pattern all year. Leading indicators of global liquidity imply a slight decrease over the medium term and a significant increase over the long term. Before I even transition to our 42 macro dashboard, I just wanted to highlight, put it on the screen here, just highlight the changes we made to our VAMS model. So what this chart here just shows the cumulative performance by VAMS condition, and the line just shows the percentage of that cumulative performance by volatility adjusted momentum signal condition for the S&P 500 here. So prior to the improvements that we made to, again, help clients maximize upside capture, at the lows of a bull, at the start of a new bull market, the improvement that we made was significant, and it's very, very powerful. So if you look at the percentage of cumulative performance of the S&P 500 that was captured by a bullish VAMS condition, according to our model, was only 75% prior to the improvement, and now it's 95% post the improvement. So all you need to do to get 90 to make sure you're getting 95% of the return that the S&P 500 produces, all you need to know is if it's bullish according to our volatility adjusted momentum signal. And obviously the percentage of the cumulative performance is negative when our volatility adjusted momentum signal is bearish, meaning that all of the downside risk in the S&P 500 comes when the S&P 500 is bearish. That dynamic is consistent with Bitcoin as well. As you see here, our VAMS signal captures 98% of the upside in Bitcoin when our volatility adjusted momentum signal is bullish, and then obviously the return is actually bearish when the return for Bitcoin is actually bearish when our VAMS signal is bearish. So it's an incredibly powerful tool, trend following tool to keep our clients on the right side of market risk. It certainly helps in terms of position sizing and factor rotations as well if you're buy side investor. Another thing I highlight here is the global macro risk matrix backtest. So our volatility adjusted momentum signal, we use that to power our market regime nowcasting process, which is born out of our global macro risk matrix. That's the tool we use to nowcast the market regime. And so, in terms of the improvements that we made to our VAMS model, it made significant improvements in terms of how much upside capture and downside, in terms of maximizing upside capture, minimizing downside capture for both the stock and crypto markets. So with respect to the stock market, when our global macro risk matrix indicated asset markets were in a risk-on market regime, our global macro risk matrix performed a 78% upside capture. It captured 78% of the stock market's upside performance when we were in a risk-on market regime. After the improvements that we made, it now captures 98% of the stock market's cumulative performance when our model indicates that asset markets are in a risk-on market regime. And so obviously that's an incredible improvement, and it's an incredible result in absolute terms. And if you look at Bitcoin here, our model indicates that our model captures 109% of Bitcoin's performance when our global macro risk matrix indicates the market regime is in a risk-on regime, and obviously the return is negative when market regime is in a risk-off regime. So what you see here on the page is that our model actually trades Bitcoin better than Bitcoin trades itself. It actually generates more return when it's risk on, when we're in a risk on market regime according to our global macro risk matrix, and it generates a negative return for Bitcoin when we're in a risk-off market regime. So this is why our market regime nowcasting process and our volatility adjusted momentum signal process could form the basis of our discretionary risk management overlay, aka Dr. Mo, which we use to help clients time and position time as a market. We help clients use that rather as a market timing and position sizing guide for factor rotations, particularly buy side investors. So obviously our VAM signal powers our KISS portfolio construction process as well. Just shifting gears here, if you look at the average annual return of our KISS portfolio construction process in this out of sample backtest starting in January 2018, the average annual return of KISS was plus 14% with a max drawdown of minus 12%. That compares obviously incredibly favorably to 60-40 with the average annual return of plus 9% and a max drawdown of minus 22%. And if you wanted to run KISS without our top-down and bottom-up risk management overlays, which are the core feature of the KISS process, the trend following process, then you would have a max drawdown of minus 26% if you were long 60, 30, 10 SPY Ag and Bitcoin without those overlays. And so just be aware of that. You would have crashed 3 times in 60, 30, 10 SPY Ag Bitcoin without our overlay, without our VAMPs top and market regime overlays, and you have crashed twice in the 60-40 portfolio, obviously on a raw basis, and you would have crashed 0 times using our KISS portfolio construction process. It actually got better. So if you look at the returns associated with our new KISS portfolio construction back test, which again, this is an out of sample back test, the average annual return for KISS actually improved to plus 16%. So a 200 basis point improvement on the average annual return for the program, which is getting close to starting to double up 60-40 here. And now not only is it starting to double up 60-40, it's actually now improved and better than the average annual return you would experience as an investor if you were just long those assets on a raw basis without any risk management overlay. So obviously this is incredibly powerful stuff. You know, obviously I cut my teeth on global Wall Street building models and educating and being educated by some of the world's best investors all across the global buy side. And that's what folks get access to here when you sign up for 42 Macro. So we just want to say thank you. We appreciate you. Thanks for checking out these videos on a daily basis. We just want to, just getting back into to wrap this up. We'll wrap it up with a question from our community of global investors. And one thing I'll say about our community, it's awesome. There's so many incredibly smart investors, whether they be retail investors, buy-siders, etc., interacting with each other and me in this community. We're all trying to figure out the answers together. It's a real safe space for learning. So come check it out if you like a safe space for learning at an institutional grade level. So wrapping up with this question reads, is the large cap growth trade over? It says, hello, DD, just thinking out loud here from a probability standpoint. If interest rates fall, the winners in the equity market should be SMID caps and losers should be more large cap, especially growth. If a recession occurs, we will likely see a shift away from growth and cyclicals and into risk and value. I'll caveat that or I'll pause there and say that's not necessarily true. If a recession occurs, we'd actually see a crowding into growth as investors pay up for the growth that they can find, and then we would see a crowding out from cyclicals and out of value. Value tends to underperform in a recession scenario in terms of deflation. That would be a deflation market regime. So getting back into the question, says, sadly, markets never react the way we expect them to. So what should happen and what will happen may not align. But with these observations, is it logical to say it is not wise to stay overweight large cap growth, aka 3 companies, knowing that these are logical outcomes for high probability scenarios? Am I just wanting to know if this rationale is correct, or am I wrong there? So the thing I would say is I wouldn't start any investment thesis about whether a recession is going to start and when it's going to start. The recessions are very rare occurrences. And so you need to understand that, okay, we may be late in the business cycle, but if your entire investment process is predicated on identifying something that happens like once every 5 to 7 years, then best of luck with that, because there's a lot of space and time to risk manage assets in between those observations. So that's step 1. Step 2 is, I don't think you need to overly complicate this process. Just going back to the discussion we just had about our market regime nowcasting process and our volatility adjusted momentum signal, those tools will keep you on the right side of market risk, whether we have a recession or not. You don't need to predict the recession. You don't need to predict growth. You don't need to predict inflation. You don't need to predict liquidity. You don't need to predict flows. You don't need to predict dealer gamble positioning. You don't need to predict CTA positioning. You don't need to predict Oprah Winfrey's positioning. You don't need to predict, I don't know, RFK's positioning. You don't need to predict where Donald Trump's ear is. You just need to understand that the BAM signal for a particular asset is either bullish, neutral, or bearish, and respond accordingly with the position sizing and market timing decisions that you make in your portfolio. But with respect to a recession scenario, just lending credence to the client's question here, if we do go into recession, then it's most likely that we would see a deflation market regime. And so deflation tends to favor, style factors like low beta, growth, quality. Those would be the places you want to be hiding in, dividend, compounders, et cetera. So just be aware of that. So we'll wrap it up there. Darius Dale presenting our macro minute for Friday, July 19th, 2024. I know this was a little bit longer than a minute, but guess what? I'm pretty sure you liked it. And we'll catch you back here next week. Have a great weekend. Cheers.